Again, I do want to thank the Board of Accounts for really calling this meeting and all the help they give us throughout the year. We've been talking to them about some of the legislations this past session. A little bit on interpretation about what's an appropriate expenditure from the MVH fund and things like that. So after the General Assembly leaves, we're all left to kind of figure out what their intention is. So we're working with them on that and any other type of legislation that is unclear. Again, you can ask us and we'll take it to the Board of Accounts if you don't want to contact the Board of Accounts directly. Our next speaker or presenter is Matt Parkinson, and Matt is with the Department of Local Government Finance, and he came from the private industry, really on the tech side, I think, but he does a great job working with Courtney, who's the director of DLGF. The commissioner. She couldn't be here today. So really appreciate Matt stepping in and going over some of the legislation that pertains to the budget side of the equation. So please welcome Matt Parkinson.
Morning, everyone. As David mentioned, Courtney couldn't be here this morning, and she apologized for that. But I do want to say it's a privilege to be here to speak with you all today. We work with the auditors and assessors and treasurers every day, but don't always get the chance to interact with county councils. So it's a privilege to be here, and we're going to move through material quickly because I know it's a busy day and a full agenda. But if you have questions afterward, please feel free to reach out, and we'll be happy to work with you. So we're going to cover 5 or 6 bills, again, pretty quickly, just in the interest of time. House Enrolled Act 1129 is a bill dealing with local income taxes. So we have moved fully at this point from LOIT, which was local option income tax, so CAGIT and COIT and CEDIT. We've moved fully to an integrated local income tax model at this point, where everybody's operating under one set of standards. So there was some technical cleanup during this year's legislative session pertaining to local income taxes. In the past, counties were required, or based on last year's legislative session, counties were required to use an ordinance that the Department of Local Government Finance produced. Effective this year, or from this past legislative session, the department may now issue optional ordinances, so you as a county council or the local income tax council, where applicable, can use your own ordinance if you prefer. The department is going to be prescribing procedures for submitting notices to us. Right now, county auditors upload a copy of any ordinance adopted through Gateway, which is our local government financial data submission portal in partnership with the Board of Accounts. There's a minor technical cleanup for this bottom bullet. In the past, if a county submitted information about an income tax adoption and didn't hear back, that was good news. This is actually just saying that the department or the state has to actually reply to indicate that the information was properly received. And again, I apologize. I am going to be moving through this quite quickly today. In addition to publishing notice about a local income tax potential change, the adopting body is required to notify the taxing units in the county at least 10 days before the public hearing. So that's to make sure that the taxing units are aware of what the potential implications are for them when it comes to budgeting purposes. Property tax relief saw a few changes. So for this past year, the changes that were in effect for 2016 were rolled into a group of property tax relief buckets for 2017. You all, as adopting bodies, now have the option to change the property tax relief allocation if you'd like to do so. So in the first bullet, there was some language added that defined how the adopting body had to make that decision. So it's going to be a percentage of the property tax relief money available. So if, for instance, as an adopting body, you wanted to provide 50% to homesteads and 50% to 2% taxpayers, 2% circuit breaker taxpayers, you can do so. And the way you're going to do that is to say 50% here and 50% here. The ordinance has to be adopted by November 1st, which is an extension of the prior deadline. It used to be a midsummer date. And then just for administrative purposes, two categories of property tax relief groups that were eligible have been removed. So those two options were properties that would have been eligible for a homestead deduction had the taxpayer submitted the paperwork, and also rental property. And the reasons that those were removed, it was purely administrative. There were no counties in 2017 that had these groups. For county assessors and for county auditors, there's not a practical way to identify what these two groups are. So as a matter of cleanup, those two options were removed. So for taxing units that have debt obligations that are relying upon local income tax funding, those taxing units have an opportunity to notify the adopting body of the impact of any potential local income tax changes. So they're required to do so before the date of the public hearing under which a change is being considered. Expenditure rate. So we talked about property tax relief. Expenditure rate is the other really broad category of local income tax. In the same way, that one is going to be a November 1st deadline, so any changes that are going to be made to the allocation of expenditure rate dollars has to be accomplished by November 1st. PSAP, so public safety access point or public safety answering point. Counties have the option to allocate a portion of revenue to a public safety access point. In the past, some counties had this option, some counties didn't, depending on the type of local option income tax they had before the rollover to local income taxes. So this has been extended to all counties. Public safety. So within the public safety portion of the expenditure rate, an adopting body for local income taxes, so again, the county council in some counties or the income tax council in some counties, has the option to allocate a portion of that revenue to a body that wouldn't normally receive it, so not to a city and town or not to a township. So think volunteer firefighters, that kind of thing. If an income tax body elects to make that decision to provide dollars to those groups, they are required to provide a notification to both the county auditor and to the Department of Local Government Finance within 15 days of adopting that resolution. Uh, 1450 is another enrolled act at this point that had a big impact on property tax matters and on local government. So I'm going to run through a series of the changes that were made. The first is this is going to be taxpayer focused. For a taxpayer who already has a homestead deduction and then has a change in marital status, so they either are married or they're divorced and they would like to continue to receive that deduction, they're required to refile their homestead deduction paperwork with the county auditor. And I think this is to aid in the administration for county auditors with situations that can sometimes be a little bit difficult to navigate. And then for a move that I would certainly say is taxpayer friendly, before a county auditor is going to remove a deduction for any reason or terminate a deduction for any reason, the auditor is required to provide written notice to the taxpayer of that decision. The notice can go through traditional mail or through email. 1450 added some new provisions relating to penalties on delinquent property taxes. So now a county treasurer and a county auditor have the option to work with a taxpayer to either negotiate or settle on delinquent property taxes or on the penalties on delinquent property taxes. If the auditor and treasurer do decide to work with the taxpayer, they have to come to a written agreement that is provided to the taxpayer or to the taxpayer's representative. And I'm sorry. Before an auditor or treasurer can engage in this action, it has to be approved by the county fiscal body. So you all have the option to let the auditor and treasurer know if you're okay with them proceeding with these types of moves. An auditor who waives, negotiates, or settles penalties has to document the action. The department is in the process of defining our guidance for how a county auditor is required to do so. And then importantly for the Board of Accounts, when the Board of Accounts is working with your county for audit purposes, if a county auditor and treasurer have decided to work with the taxpayer to settle or waive penalties, they have to be able to provide that documentation to the Board of Accounts. For budgeting purposes related to cumulative funds, this is really just kind of getting in the statute what the process has historically been. So a cumulative fund they're often trended down over time. And then what sometimes happens just through general course, and this is cumulative funds and not, a budget can be adopted or a rate can be adopted at a certain level, ultimately certified at a lower level. If the following year the county or any government wants to increase that cumulative fund rate above the rate that was certified in the prior year, they have to reestablish the cumulative fund. So again, this is the process that was in place, but it gets it in the statute. I do want to take a moment and point one thing out that wasn't statute from this year, but does take effect for the following year. So through 2017, cumulative fund establishment and reestablishment it goes through the month of July, so it's August 1st or August 2nd deadline for governments to wrap that process up. Beginning in 2018, the cumulative fund establishment or reestablishment deadline moves back a few months and has to be accomplished by the beginning of the month of May, which means that you're going to be thinking about cumulative funds really at the beginning of the prior year. So again, that's not this year's legislative session, but it does take effect in 2018. If you have questions about what that's going to mean for you as an adopting body, please reach out to us. We'll be happy to work with you on it. Okay, I'm going to move quickly through 1043. 1043 adjusts a few of the thresholds for controlled projects and then for petition remonstrance and referendum. The idea behind this, at least as I understand it, is these thresholds hadn't been adjusted in some time, so it was an attempt to recognize the kind of increase of costs over time. So for controlled project, the definition of a controlled project, if it's in this year, in 2017, controlled project threshold is set at $2 million. In 2018, that threshold moves from $2 million up to $5 million. And then importantly from here, and this is where the real key changes, it's going to be indexed to the assessed value growth quotient. So the AVGQ is a number released by the state budget agency each summer. For budgeting purposes, it's in effect the amount by which your maximum levy can grow year over year with a few tweaks. But the control project threshold definition is going to be tied to AVGQ starting in 2019 and moving forward. So controlled project is defined by either the lesser of the number that's on this screen here or an amount that's equal to a fraction of the gross assessed value for the political subdivision that's preparing to engage in the controlled project. Petition and remonstrance and referendum goes through a similar change. The threshold is moved up from $12 million to $15 million in 2018, and then really importantly in 2019 and moving forward, that number is going to be tied to assessed value growth quotient. So each year you're going to see that threshold amount grow by the AVGQ. We have the same idea as we did for controlled projects, where it's the lesser of two amounts, so it's the numbers on the prior screen or a fraction of the assessed value growth quotient. And then similar for the referendum. And I know I'm moving quickly, but just trying to make sure that I respect the time constraints that we have. There are a couple other items to note besides just the dollar amounts. And this one is new, and it's going to be an important one to consider if you happen to be engaging in multiple projects within 1 year. So the referendum process is automatically triggered if a controlled project plus the sum of all controlled projects from the most recent year are greater than $25 million. So if you're a county or if you're working with a government that happens to be engaging in a variety of projects, this is a new dollar threshold to make sure that you keep in mind. Prior to issuing bonds, the government has to hold a couple public hearings, and there's language through 1043 that describes what must be discussed at the public hearings, including, really importantly, the impact of the debt service levy, accounting for any debt service levy roll-offs that are going to occur over a 10-year period. And then finally, on 1043, taxpayers have an option to petition the Department of Local Government Finance if they believe that a project has been artificially divided to fall underneath any of the thresholds. So again, this is a taxpayer-friendly change. Senate Enrolled Act 310. 310 deals with land banks. It provides for a new deduction for someone who purchases property at the county's option. Deduction can be between 25 and 50% of the assessed value of the property. And then the county council has the option, if they'd like to, with a land bank, to allow for allocation of revenue to go to the owner of that property. So this is all to kind of incentivize the churn or the turnover of these properties that are otherwise sitting vacant. And then one other change from Senate Enrolled Act 310. For the first time, it authorizes third-class cities to establish land banks. At this point, it's counties, I believe Indianapolis, and second-class cities. Senate Enrolled Act 386 had a few different changes. This is going to be, the first one is most important for your county assessors and county auditors. In last year's legislative session, the roll date, which is the date that the assessor transfers assessed value information from their office to the county auditor, was moved forward. This year it's moved back to July 1st, and that's just recognition of the burden that puts on county assessors to knock that work out earlier. And that's actually effective for this year. So your assessors are working under this timeline for this year. And then starting next year, county treasurers have a slightly earlier deadline to mail property tax bills. So treasurers are instructed to mail their bills on or before April 15th, 2018. I'd like to actually point out on this, we are on a streak of 4 years right now of all property tax bills being mailed out on time around the state, and that's a tremendous testament to the work of your auditors and treasurers and all the local officials in the counties, and of course to you all as well. So that's something as a department we take a lot of pride in, and I think it's something that the counties should take a lot of pride in as well. 386 adds a little bit of language to appeals. So this is for a taxpayer that wants to appeal their property assessment. If a county sends out the Form 11, and that's an optional form, but a lot of counties choose to do it. Form 11 is your notice of property tax assessment. The deadline for a taxpayer to file their appeal is June 15th of the assessment year. If a county doesn't send out a Form 11 and instead relies upon the tax bills as notice to taxpayers, that deadline is June 15th of the year that the tax bills are due. So we have a pretty big change here in terms of when one taxpayer in a county is going to be able to appeal and when a taxpayer in a different county is going to appeal. It's certainly county option on whether they choose to send out Form 11s. One advantage of doing the Form 11 earlier is it's going to let this appeal process take hold earlier rather than being after tax bills are already out. And then finally, and Shannon mentioned this bill briefly as well, mobile properties. Senate Enrolled Act 455 had a few different changes to the way that mobile properties are both reported and then to options that counties have for handling mobile properties. The county treasurers in particular, I believe, were instrumental in this act. Among the most notable changes is it allows for an auction of mobile properties where there wasn't previously that option. And it's got various provisions about the kind of notices that have to be provided, about website notification, and that sort of thing. My contact information is up on the screen. I know we've moved really quickly. I'll stick around for a few minutes in the back of the room if anybody wants to talk one-on-one. But by all means, please feel free to email me, and I will get back to you with answers to any questions you have as quickly as I can. Thank you all.